Welcome to the Top Business Leaders Show, powered by Rise 25 Media. We feature top founders, executives, and business leaders from all over the world.
Hello, listeners. I'm Bela Musitz, the host for this episode of the Top Business Leaders Podcast, where we feature CEOs, entrepreneurs, and top business leaders in the business world. This episode is brought to you by Rise 25. We help B2B businesses cultivate and reach their dream relationships and connect with more clients, more referrals, and strategic partnerships to get your business return on investment through Done For You podcast. If you have a B2B business and want to build great relationships, there is no better way than to profile the people and companies you admire on your podcast. To learn more, go to rise25.com or email us at support@rise25media.com. Today's guest on the podcast is Pano Anthos. Pano is the founder and managing director of XRC Ventures. Prior to starting XRC Ventures, he served in leadership roles for media, retail, consumer goods, and industrial companies. He also founded 4 digital media and software startups. Welcome to the podcast, Pano.
Nice to meet you. Great to be here.
Yeah, it's as exciting. So tell us a little bit about XRC Ventures.
Well, it was started in late 2015 because of my wife. She had gone back to the retail world after many, many years of other jobs and needed wanted to do some part-time work, keep busy. And she took over a store up in Wellesley, Massachusetts. And she had not been in a store in, as I said, tens of years, probably 25 years. And when she came back after the first day of work, she said to me, I said, "How are you doing? Is everything okay?" Imagine being out of the computer industry for 25 years and then showing up one day and being expected to be productive. Yeah. She said, that's unheard of, right? It would never happen. She said, "Oh, I'm fine." I said, "Well, how's that possible?" She said, "Nothing has changed." So that's 25 years at least of no change in the retail industry. On top of that, I had already been following the fact that we were overstored by probably 50%. We have 50% more stores than we need in the US at the time. Amazon was still the e-commerce provider for Target. Can you imagine that? Amazon was the e-commerce platform for Target back then. And no one took Amazon seriously or mobile seriously. So when I saw all of that, I have a history of being early, sometimes too early, and I can always walk you through that both positive and negative out of that. But this time I decided that being early could be really exciting by investing really, really early in a specific category. There's in an accelerator world, there's Y Combinator, which is just, the 800-pound gorilla. They'll put money into everything. There's Techstars, which creates bespoke accelerators for individual corporates, around different categories. But no one was doing retail and consumer really. And I thought, this is an area where it's going to be massively disruptive. Corporates are going to be really shaken in their boots. And it's a great time to invest really, really early, knowing that it's going to take time for some of these startups to mature and have their impact. Yeah, and that's how I got started. I raised a bit of money just to get started. And then, now 9 funds later, we're rock and rolling, 18 people full-time on the team. We're having a lot of fun.
Yeah. So did you have a background in private equity?
I had been involved in 4 startups. No, I was on the other side of the table. And I watched how I was treated by private equity venture investors, some well, some not so well. And I realized that I could apply my learnings as a founder and provide small amounts of capital, knowing that it couldn't make a mess of a small amount of capital, and then provide a lot of coaching and expertise around those companies.
Yeah. So you provide predominantly pre-seed funding?
First money, often the very first money coming in. So we have many examples where we're the first dollar, first check.
And is that convertible debt or is it always equity?
It's safe notes. Y Combinator came out with a simpler structure. Yeah. As you know, a note requires repayment, or can require repayment. We don't ask for payment back. That's what the difference on the safe is.
Yeah. Yeah. Now, one of the challenges in being an early investor is that chances are the company's going to need additional money.
Mm-hmm.
And so do you participate in the follow-on rounds of investing as well?
So in 2019, we actually set up an opportunity fund, which literally is the opportunity to continue to invest in the winners. And roughly 65% of the opportunity fund investments, we raised about a $20 million fund as a follow-on fund, first fund. About 70% have been accelerator companies that have gone on to further success.
Oh, excellent. So you run your own accelerator as well? Is it a virtual accelerator or a physical accelerator?
Well, it used to be entirely physical, and then COVID hit and then went entirely virtual. And now it's whatever you want to call it, hybrid. We actually have our demo day on the 13th of June, where it's a physical day at Parsons, downtown, 5th Avenue and 13th Street. Everyone's invited. It's online. It's a big party. We'll have about 15 startups presenting across different sectors: healthcare, consumerization of healthcare, consumer brands, retail technologies, supply chain. Yeah, so we are both physical and virtual. Just the nature of the world today.
So if I'm a budding entrepreneur and I'm thinking about starting a business, right? I have more than just an idea. Maybe I have some notes scribbled out on a pad, maybe even the skeleton of a business plan. How do I engage with you and take me through those steps?
Yeah, I would say the most important thing to do first is make sure you've talked to enough potential customers of what you're building that you are convinced and that they are convinced that you should build this. It's not really about me or our team or our investor base. It's about the customers and the consumers who would be using this product. If I could share one observation I have seen be probably the largest startup reason for failure is a lack of real understanding of what the consumer wants and needs. We tend to project what we want and need on others. Sometimes that works. Often it doesn't. And it doesn't because we don't listen carefully enough to the consumer. So the first thing rule of thumb is show me some evidence or proof that you've got enough consumers wanting this product. And even if the product is even poorly built, the first version, that they're so excited about, they can't wait until version 2 comes out.
Yeah. So I often think there's a significant difference between a potential customer being interested and actually writing a check. How do you sort of sort through that when an entrepreneur comes to you and says, hey, look, I got these 10 people and they're all interested?
Yeah. So it's a great question. There's actually a great blog post that a guy named Josh Koppelman wrote years ago at First Round called The First Dollar, which is the kind of the challenge of freemium solutions is it's great to have a freemium solution, but no one's paying. But getting that person to write that first dollar check is a big deal, right? I'm with you 1,000%. What we ask our startups to do in their interview process is not ask the question, would you pay for this? Or would you pay $5 for this? We would actually ask them to say, how much would you pay for this? And I'll give you a little story. It's really kind of indicative, if you don't mind. We had a company that wanted to build and built a beautiful fixture for drinking water that any retailer could install and that any consumer could walk up with their water bottle and create a sustainable platform, because then no more plastic water bottles. So you make these water stations, everywhere. And he raised $2 million on this idea. It would be hard to do today, but he raised $2 million on this idea, got the units built, and then installed a few and saw no traction whatsoever. And he couldn't understand why. So I said, well, why don't you go? I said, have you done the first order of work that any startup should do, which is really see if the consumer wants this? He said, how would I do that? I said, well, what's a proxy for this beautiful water station? I mean, this water station had like a motor in it. It would turn on. It would do all these fancy things. I said, what's the easiest way to compare filtered water, which is what you're selling, to non-filtered water? Well, he still couldn't figure it out. But I said, I want you to put 2 pitchers of water out on a cardboard table in a coffee, and the coffee shop was happy to do it. And on that one picture, you have filtered water, $1. Then you have New York City tap water, free. And I said, and just stand there for 2 hours and just watch to see what happens. He came back really dejected. He said, not only did no one wanted to pay $1, they kept going to the free one, but they wouldn't even pay 25 cents for this. I said, so what does that tell you? He said, New York City is not a market for filtered water. I said, precisely. I said, why were you building this without testing this concept first?
Right.
And I said, now, where do you think this would be a really valuable solution? He said, cities with bad water. I said, great. Detroit was having their epidemic at the time, right outside of Detroit. He says, I have no interest in living in Detroit. and so the place where it was needed most, that would make a huge difference, he had no interest living there. So it's one of these things where people have projected that, New York City, of course, would prefer filtered water to their own. No, tap water is perfectly fine, right?
Right.
So it's just missing the mark of what a customer needs versus what you think the consumer needs is really a big issue.
Yeah. And I imagine that's probably one of the more challenging things for entrepreneurs to come to grips with.
It is. I have a great another story. We were the first investor in Billy. Billy is the Dollar Shave Club for women. It got sold for hundreds of millions of dollars after just 4 years of operation. So it was a great outcome for everyone. And the team showed up at our accelerator with nothing but a PowerPoint. And it wasn't even a very good one at that, but a great team. And they were trying to decide what kind of razor to produce, what color the razors should be, and what the price point should be. And I said, he said, how would you go about this? And I said, well, what we see you should do is prototype this as much as possible. And he said, well, what do you mean? I said, well, why don't you build 4 different 3D, because Parsons, which we're affiliated with, had 3D printing machines. Go print 3 or 4 different 3D facsimiles, prototypes of a razor, and ask them which handle did they prefer. And sure enough, there was an incredible unified, vote for this one form factor. I said, okay, so that's the first question. Now the second question, which color? I said, do the same thing. Go out on the street corner. He was literally in Union Square with a cardboard table, same model, Ed Parsons doing the same thing, asking people walking by, which color do you prefer? And people did, and they voted. And he had 150 votes, and that's statistical significance. And sure enough, pink, which was not the color they would have preferred,
right?
That was not what they would have had done, was the color that the vast majority of women wanted. So it's one of those examples where you can be too smart for your own good. You can be building stuff for yourself, which is not really the point, right? So that, to me, is the first cardinal mistake founders make, is they don't really listen to the consumer or ask the consumer, how much would you pay for this? The second thing they don't do is they don't acknowledge or really understand who the competition is. You every day, we live in the minds of consumer every day. So a consumer is making choices, more frequently than artificial intelligence is in many respects. Everything you do, what shirt you put on, what you wear, what you eat, you're making decisions every day, all the time. And those decisions really are binary, meaning I'm going to do this or I'm going to do this, right? It's very, very rarely can you compromise on a decision. You make one or the other. Again, competition is for my solution versus the other solution that you already got, right? So you're wearing a blue shirt right now. If I was trying to sell you a red shirt, the blue shirt's my competition in so many words, right?
Right.
We don't acknowledge that. Entrepreneurs don't think there's any competition way too often. And doing nothing is probably the biggest competition of all, because we're lazy. Human beings are inherently creatures of habit. And so we don't love change that often. And so forcing change and changing my behavior is expensive, but that's often the competition. So those are the two things. We don't listen to the consumer. And the second thing we often don't do is we don't really understand what the competition really is.
Right. As you're saying those things, Pano, I'm thinking to myself, this is really good advice, not only for startups, but also for existing companies, right? As you think about your existing product or the next generation of your existing product, that connection with the customer is so critical and it's so often overlooked.
Yeah, we call it the customer contract. So every dollar that I as a consumer give to a producer is a contract. I'm giving you $1. I expect something in return. Now, in economics, we learned this whole thing about value and exchange, but we don't think about it at the kind of technology level. But it is. It's a big exchange that we give, and we often don't give a proper reward to the consumer for the dollar they're at, and they don't come back.
Right.
When they churn out, that clearly that dollar that they gave you wasn't, valued, by us, and certainly the consumer didn't think they got value out of it.
Right. And consumers have so many choices these days.
Precisely.
You get one shot. And if that you don't connect, you're done. It's over with that particular person. It's almost impossible to win them back.
Yeah. Certainly on consumer brands, it's that way. Technology, less so. I mean, Twitter could fail 100 billion times, and it did, early days. And people there was no alternative to Twitter, and it was a cool thing, and we were willing to put up with it. But consumer brands, if a car dies in the middle of the road, you're not going to like that car very much, or want that car again
for a long time.
Exactly.
A long time.
Exactly.
Right. So, tell me a little bit more about the accelerator. So, how does one get in? What sort of services and programs do you offer?
So the accelerator is an application process that's on the website. It's open twice a year. We take anywhere between 7 and 10, 12 companies in a cohort. We have certain categories that we look for. Founders are 50% of the weight. What kind of founder are you? And the expression we like to use is, you have 2 ears and 1 mouth for a reason. Demonstrate that. Right? Yes. Give us examples of how you've listened, changed your behavior, and came out the better for it. And if you can't provide that life cycle of listen, learn, and repeat, then you're probably not going to be a great founder in this world. So that's a big, big component of it. The second evaluation criteria we put together is the category that you're in, and whether there's a headwind or a tailwind behind you. Right. So coming out and saying, I'm building a mobile application, that's so yesterday, that's just not going to be very interesting today. Right. That's table stakes. In 2006, if you were building a mobile app, that was all the cool thing. So headwind, tailwind gets into like the trends. Are we going in a positive direction or negative direction? Then we look at micro trends, which is specifically within a category, what's going on. And then the question is, how many have built the same thing already? And you'd be surprised how many people seek and spend time and money to build something that's already been built, and they've never done the research. Google is an amazing tool, folks, right? Use it. Yeah. Scour the web. It's amazing what you can find. And just to give you some perspective, we work with a number of corporates in helping them acquire brands. We have shown a couple of the beauty companies over 3,000 skincare brands in the last 2 years. 3,000. So you got to do your homework, right? You got to know who the competition is, because the corporates will, or the venture funds will. And the last thing you want to do is show up and say, oh, I've already seen that. It's just not a pleasant picture. It's a great waste of everyone's time.
Right. Very
And what
nice.
do we offer? So what do we offer quickly? All the services that, around training and helping an entrepreneur be better at what they're doing. The big thing we're providing is a gateway to the next round of financing and what the metrics are that you need to get there, and then the right introductions to help you get there. No guarantees, of course, but then there's a ton of mentorship. We have over 400 mentors. We have probably the best Rolodex in the retail world. We can get you to any retailer at any level that you want to get to, but your product's got to be ready. This is also the challenge, is people want to be introduced to the CFO of ABC company, but their product isn't ready for ABC. It's just, so usually you got to start a little smaller. They want the big kahunas, but the reality is they should probably be dealing with the smaller fish for a while and build up. And if you look at how Stripe built their business, they start with a bunch of startups, tiny startups. And we always recommend going in the startup world, which we've got over 150 startups that we've invested in, plus a network of others. So we can be really helpful, but at the end of the day, we see time and time again that founders make the biggest difference. It's not a guarantee, it's a necessary condition, not sufficient.
Yeah.
But they can have a huge impact.
It strikes me that one of the challenges for any young company and a growing company is hiring people and finding talent. What are your thoughts about how you can help companies do that? How you can help startups do that?
Well, the problem is the real problem is they can't afford to hire the talent that's available. Up until recently, there was an arms race for talent. Right now, there's been these massive layoffs, and so there's a lot of talent floating around. I find that usually recruiting is a function of sharing your vision and finding folks who share your vision.
Mm-hmm.
That is what you being articulate about what you're trying to go accomplish usually brings people to the table who want that same vision and are willing to do almost anything to get there. They really don't care how much they get paid. They know they'll get equity. They know the equity will turn into something material if this is a great idea and a great team that you're together with. I find that far more of the challenge. And frankly, a lot of founders don't do a great job of articulating their vision.
Right.
In a way, besides just venture, just on a recruiting basis. So that's the biggest miss. How can we be helpful? We spend a lot of time on messaging. It's ridiculous how much time we spend on it, but the reality is I use the analogy of a ballerina. So ballerina gets up and dances, and everyone sees the ballerina and says, "Isn't that beautiful? And doesn't that look simple?" To the point that a 2-year-old watching that same ballerina will get up and start dancing around as if they can do the same thing, right? That's the emulation effect, right? Well, you know that a ballerina to be at that stage of simplicity took 20 years to get there. And we try to tell the startups to say something simply and easily requires a ridiculous amount of practice and iteration and fine tuning and tooling. You just don't get up there and just start spouting. But you should be shocked at how many people think that that's what they can do.
Right.
They walk in with gobbledygook, 3 pages of nonsense instead of being able to have a pithy expression that captures the essence of what you're doing in 5 words or less.
Yeah. I think about startups and companies, young companies, early stage companies that make a product or service of some types, a product that you can put in a box at the end of the day and UPS will come pick it up and ship it off to your customers. You're in a business, in the private equity business, venture capital business, that's a little harder to sort of define, right? I mean, yeah, you can measure the performance, right? It's a return on investment. How much cash did I give you? How much did you give back to me as a limited partner? That's pretty easy, but that has a long time constant typically associated with it as well. So when you think about businesses that are less crisply defined than someone making a widget, what type of advice do you have for those entrepreneurs?
So advice meaning in terms of how to measure success?
Well, number one, painting the vision, right?
Mm-hmm.
How do you tell the story? Because people can't hold it in their hand, right? They have to imagine the whole darn thing. The whole thing is an imagination. So how do you tell the story? And then how do you measure your progress along the way?
Yeah. So the good news is there's actually analogies all over the place. And I'm a big lever of analogies. Human beings. So there's a whole science on bias, and there's 21 different types of bias that crop up when I speak to you. Your brain is processing the information I'm giving you, and you're running through a bias filter that's extraordinary. And there's some great books out there. It's fascinating what goes on in bias, right? There's all kinds of bias, visual bias or auditory bias. So the first thing we talk about is analogies are a great way to combat bias. So X for Y. We're building X for Y. We're building, or the Hollywood pitch. Batman meets, Catwoman. I don't know, but you reference things that already exist, that people already understand, and you bring them together in a new way of describing them. You don't ask them. Educating a market is really expensive. And the last thing you have time to do is educate a consumer. If you say, I'm building, polymorphic, 3-dimensional, gobbledygook, it's going to take you 25 minutes to explain what that means.
Right.
So you don't want to be using language that's complicated, off-putting, or requires tons of background and education. You want to keep it as simple to your point that your grandmother would understand what you're doing. Right. So messaging it to your grandmother is really, really a valuable image in your mind. Just like keep that in your mind, you'll do a much better job. And that's the problem is we get wrapped up in ourselves. So analogies are really critical. And then there are other forms of bias that you have to be able to counteract, especially when you're dealing with venture funds. The classic one is women pitching men, right? And men going, well, my wife doesn't use that, or they're using their wife as a proxy for whether this is good business or not. That's terrible.
Right.
But that's done all the time, because the male can't necessarily associate. Well, first thing is you should have female partners, number one. And number two, you should have a better approximation for what a woman goes through, as an example. That's just one form of bias. Yeah.
So what words of advice would you have for someone who's contemplating, and we've talked about this a little bit, but what words of advice would you have for someone who's contemplating starting a business?
Yeah, as we said, you got to ask a lot of people. Very blunt, candid advice, meaning, would you pay for this? How much would you pay for this?
Yeah.
And not, would you pay $10? Because anyone will say, he wants to hear $10. I'll tell him $10. So you don't say that. The second thing is you build a prototype or something simple, a version of it, and you just see if people really like the idea.
Yeah.
We go too fast into full production mode. And even Paul Graham, I have a lot of respect for, said, build something that doesn't scale. Try something out, build a prototype, but just show someone something that you're doing. And I built an entire application back in the 90s, a long time ago, in Oracle. I prototyped an entire solution for Warner Lambert, BASF, and Motorola. And I prototyped it in an application layer that would give people a picture of what I was building, but I didn't have to build the whole thing. And I raised, $4 or $5 million to do that. So prototype is a great way of going.
What about what type of advice would you have for an entrepreneur when they think about how to finance their business? Should I go venture capital? Should I go, beg for money from my friends and family? And how should they think about that?
Well, so the great example, the great piece of sage advice I was given: ask for advice, you get money. Ask for money, you get advice. And so if you go to a bunch of financiers and you say, I really want your advice on this. I have this idea, but I'm not really sure this is financeable. What do you think? Very different conversation than give me money.
Right.
So I would go and ask for advice from as many people as you can, fit into a couple weeks of interviews, and ask point blank, what do you think of this idea? I need your perspective. Where should I go for money? And if it's a really good idea, people will come and say, I actually have this fund over here. Let me tell you about me. And then they start selling themselves to you. So you always ask for advice. You don't get the money necessarily, but you almost never get the money by asking for the money.
Right. That's great advice. That's a great saying. I'm going to keep that one. File it
Go
away.
for it.
So let's talk.
Well,
as I have said many times in the past, I've never had an original idea in my whole life. Everything I have, I begged and borrowed and stolen from others.
Absolutely.
Let's talk about Demo Day again. You talked about it a little bit. Elaborate a little bit more so people might be interested in going.
Yeah, so it's a coming out party for startups, and it's a party for everyone around. I think it's important for people to realize that it's a pitch, but it's a pitch to your grandmother. It's a 4-minute, tell your story as a narrative, first person or meet Susie kind of storytelling. Super simple, get the message across, get off the stage, and then take the orders. Like, the idea is that people will come up to you and say, I'm really interested in, can I learn more? That's all this is about. And also meeting each other. The ecosystem is getting quite large. And so people love to hang out and see each other. And candidly, we did our last Demo Day back in April of last year. COVID had just had another crest. And it's so hard to believe just a year ago, we were still worrying about COVID in a deep way, wondering if we should cancel. So this time around, we're expecting a great turnout already. It's at Parsons. It's a beautiful Tishman Center. The auditorium there is extraordinary, 13th and 5th. It starts at 3:00. It ends at 6. Come as you can. It's also great. Also a great exposure for startups. If you're an entrepreneur thinking of building something, listen to the stories that are being told. See who's successful. Do you think they're going to be successful? It's amazing that your own filter is actually pretty good, right? Oh, I really like this one. Oh, this is terrible, right? So a lot of opportunity there for sure.
Yeah, there's a lot that potential entrepreneurs and founders can learn just by sitting in the audience and watching others sort of do these things and say, "Ooh, I really like the way they talked about the market. I really like the way they, think about their product and stuff." There's a lot of good takeaways. So what was the date again? I can't remember. If
June 13th.
June 13th. And now, are the companies that are pitching, are they all from the accelerator, from your accelerator?
Yes. We're also going to have a couple alumni companies coming back and talking about their experiences in the later stages of life. But yes, they will be all presenting.
Yeah. So in starting the venture firm, private equity space here, what were some of the lessons that you've learned from, if there's other people listening to this going, gee, I'm going to start a venture capital firm. What were the lessons you learned?
So, timing is everything. This is not the time to start a fund today, right? It's the worst fundraising environment in 15 years, since 2008, the crash. So timing is really important. Just by the way, startups, you can be too early and you can be too late in the startup world. And too early is as bad as too late. You have more pride in, I was the first, but who cares, right? You're out of business. So timing is really everything. The second thing is, again, interview a lot of people and ask for advice. How did you get started? How did you get started? What did you do? The key thing today is investors are not excited by private equity in and of itself. They want to know, what are you going to do differently? What is your spin? What is your angle? What's your point of differentiation? What's your asymmetric advantage, using all these kind of technical terms? What's your way of winning that other people can't simply just pile in and win on you? And you watch some of the funds like Andreessen just throw money everywhere. They're putting money in every possible kind of quadrant, which is kind of weird because that's more like what an accelerator does. Accelerator puts a lot of money in a lot of companies. Andreessen is just throwing money everywhere, trying to figure out what sticks. So, and they have the advantage that they've got a name and somewhat of a track record, but like a lot of the funds right now, that those funds aren't doing that well, right? All across the board, not just Andreessen, but just in general. So I'd say that you really have to, and also, so have a point of differentiation and prove it even in small doses. So we have created a new structure for consumer brands that we don't really talk about much, but the fund, we kept super small just to prove the model before going out and raising a much larger fund. And if you watch most of the great venture funds, they start out super small with 5 million. Kirsten is at Forerunner is a great example. Kirsten Green, she had $5 million fund, then she went to 20 or 25, then she went to 50. So they just incrementally go. They don't go from 5 to 500 million overnight. That's a rare situation. And pattern yourself after that and realize it's going to take time. The other thing you should be able to do is survive without the fund, meaning if you have to have the fees from the fund to stay alive, that's a catch-22, right? Think about it.
That's right.
You have to give yourself 2 years to raise enough capital to keep yourself alive. That means you have to have 2 years of capital to not need in order to kind of stay alive. So it's the chicken and egg problem that if you need the money and you have to raise it at the same time, very, very difficult to do.
Yeah.
So give yourself plenty of time.
Great advice. Great advice. So where can listeners learn more about the venture firm and you?
Yes. So we're at www.xrcventures.com. And they can always reach me at Pano at xrcventures.com. I try to respond to every email. Sometimes the answer is, sorry, not our sector. Or often it's not our sector, but I try to be helpful where I can.
Yeah. Is there anything that I have not asked you that you'd like to share with our listeners?
Truth in a dare, 2 truths in a, just kidding. No, I don't think so. I think you've done a phenomenal job. I think the thing that people sometimes need to remember is we're not a ubiquitous fund like Y Combinator, which will do anything in the world. We're very focused on consumer brands in one category, retail or technology that the consumer is somehow affecting or touching, supply chain, e-commerce. But we don't do like industrial, machinery or robotics of crazy natures.
Right.
So those things are very applicable. And I would really suggest strongly that founders look at what's gone on before them. Like if you're in the F&B space, food and beverage, and you're trying to build a new food brand, really take a strong look at what is out there today and whether it's successful. You can get on Crunchbase. You can look at the list of all the F&B companies as an example and ask yourself the question, do I have a reason to exist? And then go ask a bunch of people, should I exist? Then think about building the product. Do not do it the other way around. And too many people build a product and then try it. So anyway, that'd be my last piece of coaching advice. And yeah, we'd love to help any way we can.
That's great. Hey, Pano, thank you so much for being a guest on the podcast. I really enjoyed our conversation.
I indeed it as well. Thank you so much.
Thanks for listening to the Top Business Leaders Show, powered by Rise 25. Visit rise25.com to check out more episodes of the show and to learn more about how you can start your own podcast.